Hello, welcome to AGN 3613. In the last session, we addressed the book value or the book depreciation and the different methods used to calculate the book value. As a continuation of the depreciation, this session we will address tax depreciation and how to include that in our calculation for the net income. The tax depreciation, as we stated before, is used to compute income taxes for the IRS. The method used to calculate this kind of depreciation depends on the year of the asset. For assets placed in service prior to 1981, we use book depreciation methods, which is the straight line and the declining balance. While for assets placed in service from 1981 to 1986, we use accelerated cost recovery system or ACRS table. And for assets placed in service after 1986, then we use modified accelerated cost recovery system, which is MACRS table. For the modified accelerated cost recovery system, the calculation is based on personal property or real property. For the personal property, the depreciation method based on the declining balance method, and we switch to the straight line. The convention here is using half a year instead of the full year, and at the end the salvage value is 0. So with 0 salvage value, half year convention, and using the double declining balance method, switching to straight line. For the real property, we use the straight line method, but we use the mid-month convention, and we'll talk about how to calculate the mid-month convention, and with also 0 salvage value. The modified accelerated cost recovery system property classifications are the guidelines that were set to determine the tax depreciation amount. In these guidelines, several classes of assets were created, each with a lifespan called recovery period. So they give you an example. They will tell you if your property matches this, then this is the recovery period and this is the midpoint for that class. Those periods don't correspond to expected useful lives. As shown in this table, we have there are 8 categories of assets: 3 years, 5 years, 7 years, 10 years, 15, 20, 27 and a half, and 39 years. For example, investments in some short-lived assets are depreciated over 3 years by 200% double balance, double declining balance, and then switching to the straight line depreciation, and so on. The rate at which the value of an asset declined was estimated, and the rate was used for tax depreciation. So using the MACRS established or prescribed depreciation rate, we call it as a recovery allowance percentage for assets with each class. The table in this slide shows these rates. We can determine the yearly recovery or depreciation expenses by multiplying the assets depreciation base by the applicable recovery allowance percentage. Let's look at an example to understand how to calculate using MACRS. So for an asset that's worth $10,000, property class will be 5 years. Using the double balance method with half year convention, the percentage for the first year will be half. And remember, in the double balance, we use a 200% rate with 40% switching to the straight line. So half of that is 20%. If we use the table, or we look at the table here, or the previous table, we can determine or implement the rates, the different rates, and the calculation for this method with zero salvage will be shown in this table here. Now, to understand more, how did we get that 20%, 32%, and so on, let's go to the next slide. Now, remember that we said for the 20% is half the month. That's why we multiplied. We know that 40% is the switching from double declining balance to the straight line. So with 40% times half, that's 20%. 20% times 100, that's 20%. This is the 20% that we were talking about at the beginning. So we took only 20%. Now, in the second year, using the 40% multiplied by the leftover, which is 100% minus 20%, at that point, that's 80. So 80 times 0.4 will give us 32%. So now we have 32%. Switching to the straight line, we multiply by the leftover period. We took half a life, or half a period, half a year. So the left is 4 years and a half. So to switch, we have 1 over 4.5, that's n, or the leftover period, multiplied by 80%. And that's the difference between the 100% and the 20%. And that will give us 17.78%. So instead of using the double declining balance of 32%, we went down to 17.78% for straight line, and so on, going down to switching to 5.76% from the double declining balance to the straight line. So the whole idea is to reduce the amount that you will pay taxes on. And actually, you can see a comparison here between a conventional double balance switching to straight line and the MACRS with half-life convention. At the end, we have $1,080 as an asset that you need to pay taxes on, while using the MACRS, we got $576 just to pay taxes on. So the amount that we need to pay tax got reduced. Real properties are classified into two categories: residential, which is like rental properties with 27.5 years lifespan, and commercial, and those are buildings or properties with 39 years lifespan. When depreciating such property, we use the straight line method with zero salvage value and mid-month convention. For example, if we have a residential property placed in March, then we calculate the number of months left from mid-March, that is 9.5 months out of 12 months. And that will be multiplied by the straight line percentage divided by 27.5 years, and that's the lifespan that is assigned for this type of property. So the recovery percentage will equal 2.879% at that point. One of the things that gets everybody confusing is, okay, what is the net income and what's the cash flow? There is a difference between when you say net income and cash flow. And that's very important to know the tax depreciation and how we can determine in the accounting the profit or personal net income versus the money that's going back and forth on for the company or within the company. The taxable income will equal the gross income minus the expenses. Now remember that the expenses will equal to the cost of goods sold, depreciation is included, and operating expenses are included. The taxes will be on the taxable income, and subtracting income taxes from the taxable income, we will get the net income. This is an example that shows how to calculate the net income. If the gross income estimated by the company for the first year is equal to $50,000 and the cost of goods sold is $20,000, depreciation is $4,000, and operating expenses is $6,000, subtracting the expenses from the gross income, we will get $20,000 with which will be a taxable income. So if you calculate 40% of that, then you have to pay taxes $8,000. So if you pay $8,000 taxes from the $20,000, then you are left with $12,000, and that's what's called net income. So although you saw money going back and forth, maybe in like 50,000 or 20,000, and you think that you are getting the 50,000, but that's not true, because after you subtract all the expenses that you have and pay your taxes, you are left with the net income that is considered as your profit. This figure shows a comparison between cash flows, which is the capital expenditure, and the allowed depreciation, and that's not considered as cash flow. Comparing net income with cash flow, we will find that net income is an accounting means of measuring a firm's profitability based on the matching concept, and the costs become expenses as they are matched against revenue. The actual timing of cash inflows and outflows are ignored. While with the cash flow, given the time value of money, it's better to receive cash now than later, because cash can be invested to earn more money. To further understand the difference between the cash flow and the net income, we can look at this example that compares two companies, A and B, which have the same amount of net income and cash sum over the 2 years, but company A returns 1 million cash yearly, while company B returns 2 million at the end of the second year. In the first year, company A can invest the $1 million that they have, while company B has nothing to invest during that period. Going back to the example before and comparing the cash flows, you can see that depreciation is not considered in the cash flows, and that makes the difference between the net income and the net cash flow. So if you look at the figure here, it will explain that the net cash flow actually is equal to net income plus the depreciation, and that's where we got the 16,000 from. In this session, as you can see, we explained the taxable income, how to calculate that, and what is the net income versus the cash flows that we have. That will be all for this session. If you have any questions, please email it to me. Thank you and have a great day.